if I move to the next slide, the first and important part of an option is intrinsic value. So intrinsic value is the difference between the cash market and the strike price of an options. So that means if underlying price is trading at 100 rupees and you are talking about 95 rupees, 95 strike call. So 95 strike call is lower than your underlying price. So underlying price minus the strike price, 100 minus 95. So that means 5 rupees will be your intrinsic value for that 95 strikes call. So intrinsic value can either be positive if you are in the money, it may be zero if you are looking for at the money or out of the money. So you need to remember that in the money strikes are only having intrinsic value, and while no intrinsic value for at the money and out of the money strikes. And assets cannot have negative intrinsic value. Why? Because you need to understand the future has delta of 1. An option cannot exceed the delta of more than 1. So that is why the assets cannot have intrinsic value. Only the intrinsic value will be there if underlying is higher compared to the strike price if you're talking about the call, or if your underlying is lower than the strike price when you're talking about the puts. So intrinsic value is the fair value and doesn't decay as per the concept. So if I just talk about the simple language, I'm talking about the nifty example. Right now, let's say the nifty is trading at 11,900 and someone is interested to buy 11,500 call. So 11,500 call is 400 points in the money. So that's why the 400 rupees will be intrinsic value for that options, and extra premium will be time value, and all the options premium are inclusion of intrinsic value plus time value. We'll also go to the NS India side to understand which strikes are having how much intrinsic value and time value. Now the formula for calculating the intrinsic value is intrinsic value for call. As you know, for call side, in the money option will be having intrinsic value, but for put side, your in the money will be higher strikes of puts. For call side, the lower strikes of call will be in the money, but for the put side, higher strikes of the put will be in the money. Because when you're buying the call, you are expecting market to go up. When you're buying a put, you are expecting market to go down. So for the call option, the intrinsic value is all about spot price minus the strike price. So as we discussed in an example, the Nifty is trading at 11,900 and you are buying 11,600 call. So if you need to know about the intrinsic value, 11,900 minus 11,600, 300 will be intrinsic value. You need to remember intrinsic value cannot be negative. It will be on zero or positive. So now look at the 12,000 strikes. Let's say the underlying is trading at 11,900 and you are talking about 12,000 strikes. So what is the formula? The spot price minus the strike price. So 11,900 minus 12,000, that is minus 100. There is no intrinsic value for out of the money strikes. Only intrinsic value will be positive, and that will be for in the money options in the call side, which are the lower strikes, in the money for the put side, which are on the higher strikes. Now if you look at the intrinsic value formula for the put options, that is strike price minus the spot price. So in both the side, call formula and the put formula, one is spot price minus the strike price, second is strike price minus the spot price. Because for the call side, lower strike is in the money or higher strike will be out of the money. But for put side, higher strike is in the money and the lower strikes are out of the money. So now
register for our free webinar. Download our app today. Link in description.